The US Treasury is swimming in a sea of record-breaking debt, and everyone's wondering what comes next. Headlines are flashing with warnings about rising debt and market jitters. But amidst all this chaos, there's a new voice calling for calm. Scott Bessent, a key figure with a history of making smart, stability-focused moves, is suggesting a different path. He's saying, let's take it slow. But can a slow and steady approach really win this race against mounting debt? Let's break down what's happening. You might be asking, who is Scott Bessent and why should we listen to him? Well, he's not just any market commentator. Bessent has a heavyweight resume. He's been a chief investment officer for a legendary multi-billion-dollar fund and advised some of the biggest names in finance. He even founded his own successful macro hedge fund. Throughout his career, he's built a reputation for being a strategic thinker who prioritizes stability and long-term vision over short-term gains. He's known for his deep understanding of global markets, currencies, and government policies. When someone with his track record talks about something as crucial as U.S. debt, the market pays very close attention. His background isn't in flashy, higher-risk bets. It's in making calculated moves designed to weather economic storms. This context is critical because it tells us that his proposal isn't a wild guess. It's a carefully considered strategy from a seasoned expert who understands the immense pressure that Treasury is under. He's essentially the captain you'd want steering the ship through choppy waters, which is exactly where the U.S. bond market finds itself today. So, what exactly is he proposing? So, what is this big plan from Bessent? It boils down to one key phrase: gradual adjustment. He's talking about how the U.S. Treasury sells its debt to investors through auctions. In the past, the Treasury might have made big, sudden changes to how much debt it was selling at these auctions. One month, they might sell a huge amount. The next, a much smaller amount. This kind of unpredictability can make investors nervous and cause volatility in the bond market. Bessent's idea is to smooth things out. Instead of big, jarring shifts, he advocates for smaller, more predictable changes in the amount of debt being issued. This means setting a clear, steady schedule for auctions and sticking to it. Think of it like a train schedule. If you know the train always arrives at 8:05, you can plan your day around it. But if it sometimes arrives at 8 o'clock and other times at 8:30, it creates chaos. By making the Treasury's borrowing schedule more like a reliable train, the goal is to bring a sense of calm and order to the bond market. This isn't about stopping the borrowing. It's about managing it in a way that doesn't spook the very people the government needs to lend it money. It's a simple concept, but the implications are huge. Now, why should you care about how the government auctions its bonds? It might sound like a technical detail, but it has a ripple effect that touches nearly every part of your financial life. First, let's talk about bond yields. When the government sells debt in a more predictable way, it reduces uncertainty for investors. Less uncertainty means less risk, so investors don't need to demand as high of a return. This helps keep bond yields, the interest rate the government pays on its debt, from spiking. And those bond yields are a benchmark for everything else. The interest rates on your mortgage, your car loan, and your credit card are all influenced by Treasury yields. So, a stable bond market can mean more stable and potentially lower borrowing costs for you. For the government itself, lower yields mean it spends less on interest payments, freeing up taxpayer money for other things like infrastructure, healthcare, or education. And this isn't just a U.S. issue. Global investors, from central banks to pension funds, hold trillions of dollars in U.S. debt. A stable U.S. bond market is the bedrock of the entire global financial system. So, these seemingly small adjustments to Treasury auctions are actually a big deal for everyone. So, how did the market react to this proposal for a slower, more deliberate approach? The initial response has been cautiously optimistic. Many economists and analysts have praised the idea, seeing it as a sensible move to inject some much-needed stability into the bond market. For months, we've seen Treasury yields whipsawing back and forth, reacting to every piece of economic data and every new headline. If you look at a chart of the 10-year Treasury yield over the past year, it looks like a roller coaster. This kind of volatility is what Bessent's plan aims to tame. In the immediate aftermath of discussions around this more gradual approach, we saw a subtle but important shift. Bond yields eased back a bit from their recent highs. The US dollar, which is also sensitive to interest rate expectations, remained relatively stable, and the stock market seemed to breathe a collective sigh of relief. Traders and fund managers appreciate predictability. It allows them to plan and invest with more confidence. While no one is declaring victory just yet, the initial signals from the bond market, the dollar, and stock indexes suggest that Wall Street sees this as a step in the right direction, a move away from crisis management and toward thoughtful, long-term stewardship of the nation's finances. Of course, no plan is without its risks. What could go wrong with this slow and steady approach? The biggest risk is that it might be too slow. If the government's borrowing needs suddenly surge due to an unexpected crisis or a recession, a gradual increase in debt issuance might not be enough. This could force the Treasury to make abrupt, larger-than-expected changes later on, reintroducing the very volatility the plan was meant to avoid. On the flip side, if the adjustments are too fast or not communicated clearly, they could still unnerve investors who might interpret them as a sign of fiscal distress. For you as an investor, this has direct implications. If the plan works and stabilizes yields, it could be a positive for bondholders and bond ETFs, as stable prices are better than volatile ones. For equity investors, lower, more stable interest rates are generally good news, as it reduces borrowing costs for companies and makes stocks look more attractive compared to bonds. However, if the plan falters and yields spike, it could spell trouble for both stock and bond portfolios. The key will be execution. The Treasury needs to find that Goldilocks pace, not too slow, to keep the market's confidence. So, to recap, the US Treasury is facing historic debt levels. But a new strategy focused on gradual, predictable adjustments to its debt auctions is being proposed to bring stability. This idea, championed by seasoned investor Scott Bessent, aims to calm the volatile bond market, which could help keep interest rates for consumers and the government in check. The market has reacted positively so far, but the plan's success hinges on careful execution. Getting the pace wrong could either be too little, too late, or create new shocks. This is a high-stakes balancing act with major implications for your investments and the global economy. Now, I want to hear from you. Do you think this slow approach will really stabilize the U.S. debt market, or is it just kicking the can down the road? Let me know your thoughts in the comments below. If you found this breakdown helpful, don't forget to hit the like button and subscribe for more deep dives into the financial world. Thanks for watching, and I'll see you in the next video.